I'd like to welcome Richard Maynier from Northcape Capital to talk through some of the market movements and opportunities that we've been witnessing. Welcome, Richard.
Thanks, Tim. Thanks for having me.
Ah, pleasure. Now, probably where we should start is that many advisors still hold a high allocation to Australian equities, although we've definitely seen actually a marked increase in international equity allocations over the recent years. It'd be a very interesting point to start with. What are your thoughts on the Australia versus international allocation? And I think more importantly, why should advisors maintain a reasonable exposure to our home markets?
Oh, well, I love that question because I am an advocate for this asset class.
Yeah.
Australian equities have generated consistent compounding returns for investors over many decades.
Yeah.
And there are a lot of advantages to investing domestically. Like most obviously, the tax advantages of being here are huge, right? A franked dividend is worth approximately 40% more than an unfranked dividend.
And clients do love franked dividends.
It's hard to look past that. Those franking credits count for a lot. Secondly, if for a client who's planning to retire in Australia, their future liabilities are going to be in Australia, I think it makes sense to hedge out some of that liability with Australian assets. So these are the obvious explanations. What I think is underrated about Australian equities is the quality of this asset class. This country is rich in quality businesses. Sometimes people think Australia is full of mining companies and slow-moving banks, and we do have our share of those, but we have global leaders who are domiciled here. Companies like CSL, Brambles, James Hardie. These are companies that have barriers to entry to global businesses and can grow. And if you can invest in a company that has those characteristics, you're going to make money over time. And if you can assemble a portfolio of companies that are like that, and they're all in different industries, you're diversified, that's how you're going to make money over the long term.
So it's interesting, your comment about slow-moving banks, for instance, because it's been interesting to watch how certain stocks and sectors have performed over the last 12 months, particularly in our banking sector. The CBA in particular, a share price that's hit $166, and it appears to be trading, well, simplistically, at quite overstretched valuation. What's your perspective on why certain stocks and sectors are trading on such high valuations? And more importantly, will this persist?
Oh, look, so CBA has been a really interesting episode in this market. That stock is 100% in a bubble. Right. The multiple, when the share price peaked, the earnings multiple there was in the region of 28 times. Historically, it's been less than half of that. You could buy CSL, which is a global leader growing at double digits, for 23 times earnings. You're paying a premium for CBA. You're getting a dividend yield in the region of 2.9%, which is half of what it would have been historically. The multiple is twice the multiple of JP Morgan, which is the equivalent bank in the US, the equivalent leading bank over there. So there's no question that the valuation here has completely detached from the fundamentals. What I find interesting actually is that there's no debate on the fundamentals for this stock.
No.
I talk to a lot of banking analysts, and no one is saying, this thing should be $200. Like the earnings are going to be 20% more than what anyone thinks. We know what the earnings outlook is going to be. There's not much growth there. It's a good business, but it's not really growing. And the valuation is just completely detached from the fundamentals.
Which raises the interesting question, Richard. Why?
Yeah. So
why?
So it's not just CBA. There are other pockets of exuberance in markets, but it's not. It's certainly not the whole market that's taken off in this manner. So my theory is that because it's not fundamentals, it must be like the weight of people buying the stock.
Yeah.
And I think you have more people these days who are running different investment strategies from what they did in the past. You have more passive money, you have like super funds taking different decisions, trying to balance the risk in their portfolio. And the active investors, they're not always thinking about what things are worth. a lot of investors these days are looking for signals, quantitative signals, and the signal might be an earnings upgrade.
Right.
So if the earnings upgrade, that's my signal to buy. Never mind what it's actually worth
Yes.
in the long term. So,
So it's a real trading mentality versus an
Yeah.
investment.
Yeah, exactly. And obviously that can work for some people,
Sure.
but I think there's an opportunity for someone in the market who actually takes a view on what things are worth. And if the market's going to be volatile and present opportunities, then those people will do well.
So let's explore that a little bit more deeply, because do you believe that our markets have actually become inefficient and concentrated, in the biggest names? How big a role do those passive funds and the super funds play in creating this environment?
Yeah, 100%.
Yeah.
When we think about a market, we think about a whole bunch of people sitting around separately deciding how much things are worth, and then they trade with each other, and the price is the outcome of that. It's just a fact that there are a lot more people in the market today who are not thinking about what things are worth. The large passive funds together own more than 20% of CPA. And that's been increasing. So we know who's buying.
Yes.
We can see that the passive funds are buying,
Yeah.
and we know that they aren't giving a fig of thought to what they're buying or how much it's worth. So we can see that happening. And my theory is that the active investors are also pursuing, to a greater extent than historically, they're pursuing other strategies as well.
Where, as you look to the market and the opportunities, obviously we're not buying Commonwealth Bank necessarily.
Yeah.
What would we be buying? Where are these opportunities starting to appear?
Yeah, so I think half of the battle is avoiding things where you're going to lose money.
Yes.
And part of that is avoiding stocks that have business model challenges, overstretched balance sheets, things of that nature. But increasingly, it's avoiding very overvalued stocks like CPA. So if you can just avoid things like that and then get exposure to the asset class, which generates compound returns, you're going to do well to start with. And then it's a matter of saying where are the good opportunities within the set of high quality businesses. And we look around the market today. I think the healthcare sector looks very interesting. CSL, I mentioned, is growing at 15%.
Yeah.
And they're trading at a much lower valuation than where they have historically, partly due to sentiment and partly just due to people not thinking about valuation at the moment.
Richard, thank you very much for taking the time to be with us today. Very much appreciated.
It's a pleasure. Thanks for having me along.